Have you ever wondered why, despite record inflation, political instability, and skyrocketing debt, the stock market refuses to crash? Every economist warns about bubbles, every financial expert predicts doom, and yet, the market keeps climbing. It almost feels unnatural, like there's an invisible hand propping it up. And maybe there is, except it's not the one you think. Today, we're going to uncover the shocking reasons the stock market hasn't collapsed yet. And these are things that the banks, Wall Street, the Fed, and global financial elites don't want you to know. Stay with me, because by the end of this video, you'll see the stock market not as a game of numbers, but as a carefully engineered system of control, and why the next crash might not look like anything you expect. To understand why the market hasn't crashed, we need to go back not just a few years, but decades. The story starts with the rise of modern banking and central banking systems in the 20th century. After the Great Depression, the US government realized that left unchecked, financial markets could collapse catastrophically. Banks could fail, savings could vanish, and trust in the system could disappear overnight. Enter the Federal Reserve, the ultimate safety net. Its mission was simple: prevent panic, stabilize markets, and protect the banking system. Over time, the Fed's powers expanded dramatically. From setting interest rates to quantitative easing, it became the ultimate backstop for the stock market. But here's the twist most people don't understand. The Fed doesn't just stabilize markets, it actively inflates them. Every time a crisis threatens, they intervene. Every time a bubble forms, they step in. And every time the public panics, they calm the storm, usually behind closed doors. This means that the stock market isn't purely driven by corporate profits, innovation, or economic growth. It's also heavily influenced by central bank policies and the hidden hands of institutional investors. Fast forward to the 1980s and 1990s, and we see a pivotal shift. Financial markets became more complex, globalized, and interconnected. Hedge funds, private equity, and derivative markets emerged, turning the stock market into a vast, almost opaque web of leverage and risk. During this time, banks discovered a crucial truth: crashes are bad for everyone, including themselves. And so, they developed sophisticated tools to prevent crashes or, at least, delay them. Take derivatives, for example. These financial instruments allowed banks to spread risk across the system, insulating themselves from sudden shocks. Then came the era of too big to fail. Banks that were deemed systemically critical were effectively guaranteed a bailout if things went south. By the 2000s, the stage was set. The market was no longer a pure reflection of economic reality. It was an engineered system, heavily influenced by the Fed and the banking elite. Nothing illustrates this better than the 2008 financial crisis. Lehman Brothers collapsed, panic gripped global markets, and here is a piece of data that should make anyone pause. Over 70% of US stock market trading is now done by institutional investors, not everyday traders. This means a handful of players can move markets significantly without anyone outside noticing. It's a repeating pattern we've seen for decades. Warning signs emerge, risk builds, and yet the market is artificially sustained, until it isn't. Here is the shocking truth banks don't want you to know: the market isn't safe, it's fragile by design. Every intervention delays the inevitable, but it also increases risk. The longer we go without a real correction, the bigger the crash could be when it finally comes. History shows this pattern again and again. 1929, 1987, 2000, 2008 crises are postponed, not prevented. And with today's record debt levels, geopolitical instability, and unprecedented market manipulation, the next crash could be faster, more severe, and unlike anything we've seen before. 3 key takeaways. 1. The stock market is not purely free market driven. It is heavily influenced, propped up, and sometimes manipulated by banks, central banks, and institutional investors. 2. Artificial stability comes with hidden risk. Every intervention buys time but increases fragility. The longer the market climbs, the more explosive the eventual correction could be. 3. Understanding the system is your advantage. Knowing how and why the market is managed allows you to make smarter, safer decisions rather than blindly trusting the numbers on your screen. The stock market may seem unstoppable, but appearances can be deceiving. Banks and central banks have engineered stability for decades, but no system is perfect. The real question isn't if a crash will happen, but when and how severe it will be. So ask yourself, are you investing based on fundamentals, or are you being carried along by an invisible tide engineered by others? The answer could define your financial future. If this video opened your eyes to the hidden forces behind the stock market, hit that like button to show you want more financial insights. Comment below. What do you think will trigger the next big market shift? And don't forget to subscribe for more deep dives into the hidden side of finance that banks don't want you to know. Stay curious, stay informed, and never take the market at face value.